my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 17 weeks ago, I said here and at every opportunity since, and I quote, "The only thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. I feel I must keep repeating this point that all things this year and going forward should be seen in the shadow of this pattern. Okay, so from the May double top, we have seen prices head lower at the start of June and thereafter. The primary target 1175 was easily achieved, and the secondary hard to reach target in the 1151 zone was achieved 5 weeks ago. The next feature is one I drew and spoke about 7 weeks ago, and I quote, "I've drawn a new, small, recent, bright red highlighted bearish Andrews pitchfork for the action during May. It is a nascent pitchfork, but I decided to place it in anticipation of a possible move lower." End of quote. Well, I have not had to do anything to this pattern, not at all, as it is still working and working well as a bearish Andrews pitchfork, showing the bearish angle of attack despite the changeover gap made 2 weeks ago. We're at the moment in between the middle tine, well, just below the middle tine above, which is currently at 1080, and at the lower time below, which is currently at 1042, and we've closed at 1042. Interestingly, the changeover gap happened right at the 61.8% absolute Fibonacci line at 1106. I spoke about this 4 weeks ago, and I quote, "Below, we really only have the 61.8% absolute Fibonacci line in the way at 1106 before we test down to the November 2020 low at 1045. That is something to ponder upon." End of quote. Now, for the life of me, I didn't foresee such a swift move down lower, but as we have done, it is worth now not considering what is below that might hold up prices. And this comes in 3 bands, plus a seemingly strong dynamic support. The first is the previously mentioned 1045 support, then a congestion between 1031 to 1033, and then the October 2020 low at 1017. Dynamic support is the late April 2020 to date uptrend, currently at 1027. They've highlighted in dark blue on my daily chart. Of all these, the uptrend looks the most formidable in relative terms, as I would ask you to bear in mind the large overhang we have on top between late January and the start of July, roughly between 1130 and 1243. Right now, along with the other bearish factors, these sit on top of the market. However, that does not preclude the market filling in the changeover gap between 1103 and 1056, which we've seen a significant attempt to already during late July, but I would point out the close on the lower tine today. Chicago soybean meal. Back in late February this year, down at 326.90, the market consolidated after a significant fall that developed from the middle of November last year. This congestion was different compared to earlier ones, as we had crossing through it back then the dark blue highlighted extension to the lower trend line, currently at 327.40, of the July to September 2021 descending triangle. I said 19 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since last November last year, that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering." End of quote. Well, prices utilized this dark blue highlighted extension to the descending triangle as a base and rallied back up, eventually ending up with a double top formed over May, and with the help of the declining long moving average, currently at 367.60, and the 50% Fibonacci line of the August 2020 to March 22 move at 390 even. The construction of this double top led inevitably to a move lower down through the primary target below at 352.40, and the secondary hard to reach target X down at 343.30 2 weeks ago. The key break lower happened at the third attempt at pushing down below the flatlining purple highlighted medium moving average, currently at 348.20, which one now must regard as a prime resistance for the future. The double top also spawned a new feature, a bright red highlighted May-based bearish Andrews pitchfork, which I drew 7 weeks ago. Now you may remember I only drew this pitchfork to help in showing the channeling lower of the market. And I was happy to finesse it or retire it as necessary. However, the market has taken on board this bearish pitchfork, at least most of the time, as we have seen prices push up over the upper time, which is currently at 325.90, in early July and again last week. And this coming after a significant changeover gap between 335.90 to 319.5. Since that gap at the start of last week, prices have recovered enough that we only have a small fraction of the changeover gap left open right now. We could put this down to the effect of the bright red tines below, or the October 2021 low that's a little lower at 309.30. However, I'm minded to look at that original dark blue highlighted extension to the lower trend line of the July to September 2021 descending triangle I mentioned earlier, as it being, if not the main factor, then a key element in the pullback higher. This now just leaves what will happen should we fill in the changeover gap, or almost fill the gap. And for this I would still look lower for a test again of the dark blue trendline extension. Now there is an argument to say the action since late December last year could be a possible large double bottom. However, right now that doesn't sit right with me, and I would suggest further testing of the dark blue trend line and maybe, just maybe, a trip down to the congestion seen between April and August 2020, between 282 even to 300 even. The key point for such an idea is something I raised here 56 weeks ago, yes, over a full calendar year ago, and on every opportunity since, especially at the close of 2023. It was how the whole of 2023 was an annual key reversal down in Chicago soybean meal last year. This feature, this potential if you like, hangs over all of this market more than anything right now, and all actions should be seen in the shadow of this pattern. Chicago soybean oil. The market's drift of sideways to lower this year has been down through 3, possibly 4 bands. These are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. With the nearby neckline extension highlighted in bright red of the October 2019 to February 2020 move, head and shoulders top actually, currently at 44.32. Then the interesting congestion down at about 42.65. I mention all these because some 54 weeks ago and numerous times since I said the following about a big descending wedge pattern that was on my daily chart back then and is now high up off the top of my daily chart. I said the following, and I quote, "I would consider the descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." This was a big pattern idea, end of quote. This was a big pattern idea, and the market's declines since autumn of last year fitted in with this, with the exceptions I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even, which is where we have been until recently. I've often stated here how I was keeping a very, very close eye on this idea, as any significant breakdown below the 48 to 46 zone could signal the start of the rest of this move lower. I said 19 weeks ago, and I quote, "So far I am not convinced of the move, that we've seen this break lower already. No, not just yet." However, 3 things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp moves. Data indicates about 3 to 4 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of the recent unusual bear channel, end of quote. Now the bear channel I mentioned is highlighted in dark blue on my daily chart and is currently at 37.01 to 44 51. And I started at the beginning of 2024. Mixed in with this bear channel and close to the upper bear channel line is the green highlighted short medium moving average, currently at 44.64. I previously used this moving average as a proxy for the upper bear channel line when I began tracking the pattern before I drew a proper upper bear channel line. Now, we saw earlier the market trying to edge out of the top side of this bear channel, culminating in the late June, early July rally that reached up to the congestion top side at the 38.2% Fibonacci line of 48.95. All these attempts have ultimately been unsuccessful, and we are back down where we have been since late April. However, we are still on top of the broken dark blue upper bear channel line, though not today. And at the same time still supported by the neckline extension, though not today, of the bright red October 2019 to February 2020 head and shoulders top. Now, these two cross over in the middle of next week, and it makes me think that the market may thus be coming to a cusp and choosing which of these two will be the dominant trend line. Now, I'm quite prepared to see prices trail along the top of the broken dark blue upper bear channel line. Yet at the same time, I cannot but help notice how powerful has been the bright red neckline in supporting this market, as well as the congestion seen down at 42.65. One way or another, the blue or the red will have to give way, or maybe even both. It may not be as early as next week, maybe as early actually as Monday, but it will be soon, and this all justifies my comments made 7 weeks ago when I said, and I quote, "What I do realise now is this chart is becoming increasingly messy and too colourful in too small an area, especially as prices start testing the bright red neckline once more and come close to the congestion at 42.65 that held up the market in early May." End of quote. Nothing since has changed my mind other than the pressure has moved closer to the market. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.